In Hawaii, there's so much to do. There's hula, there's surfing, and real estate too. We just two local guys with so much to say. So listen to the Real Estate Braddahs today.
Hey guys, it's episode 13 of the Real Estate Braddahs. Today we're going to be talking about monthly real estate stats. What season is it? Tax time, and talk a little bit, is the recession coming? Here's the legal disclaimer and legal notice. You guys can read that in your free time. But I want to introduce Dean Ueda here. You guys can reach him at deanueda@gmail.com. Are you still going to keep that CPA tag?
Yeah, I can probably take it off. I have that asterisk because I'm not in public practice. So the Hawaii Society of CPAs, if I'm gonna put that designation, I have to make it clear that I'm not practicing. So I'm certified, but I'm not in public practice. That's the disclaimer, I guess.
So it's not like a professional engineering, like a PE, where if I let mines lapse, I can't even put it anymore.
So we can still put it, but we just have to make sure that we let people know that we're currently not in practice. Like if you look me up at DCC, I am in good standing, but I don't have my permit to practice. In good standing means that I pay my dues, smaller dues, and I'm keeping up with this minimum CE for to make sure I'm navigating the grade properly.
Oh yeah, for us it's just we didn't make any bridges that fell down. So what? Some more fun stuff. What's happening in Hawaii real estate lately?
So interesting times again. I mean, we're seeing this is for February median prices compared to February 2018, but we see a slight increase for both median single family and condo prices. They went up 2% at $789,000 for single family and $415,000 at the condos and townhouses. However, contrary to the prices going up, we see closed sales going down and days on market going up, showing strengthening power for the buyers now, because now, there's less things closing and things are staying on longer. So it's giving the buyers a lot more power, I guess, and which we've been seeing for months now. And at the same time, we're seeing listings, the inventory building up, right, at 42% for single family and 31% for condos. But it's just so interesting because even though the closed sales and days on market is showing, strengthening for the buyer side, we still have the prices creeping up year over year on prices. So it's kind of interesting times, but all in all, it's still a great time for it's getting better for the buyers is basically it. And especially with the rates staying low and actually going a little lower, that it's a good time for buyers now too. So that's something good. One thing I wanted to talk about is we're talking about shifts and corrections and trying to put things in perspective. So I was going back historically, looking over the median prices historically on Oahu, identifying two of the corrections. One being the one started in 1994 with the Japan bubble bursting, and that was actually it took us 9 years to recover. And when you look at the peak, 1994 compared to the trough around 1999, it was like a 21% decline, right? And a 9 years to recover to get back up to the median price. And then the subprime crisis and started more in 2008, but the peak was in 2007. That one lasted 6 years when you're just looking at when median prices came back up to the original peak. And so that was a 6 years to recover, but that was only a 11% decline when you're looking at the peak compared to the trough, right? So, I mean, perspective, keeping things in mind is that we have, if you're an owner occupant, timing is a little bit harder, and writing out something like this is not as bad because I mean, you're living in the home and you're paying down your principal and you're building up your equity, right? So it not as affected to the owner occupants. I guess in terms of equity, if you want to tap into it, but it might be a different consideration if you're an investor, right? Trying to get back up, especially if you're investing and you have a lot of times people investing in Hawaii, it's you're trying to retain legacy wealth and you're trying to go for the appreciation because it's not really a cash flow play. But just wanted to look at that, take it into consideration, and it's a total different market than stocks. But to me, the decrease wasn't nearly as bad as the stock market. However, the recovery period was also different.
Yeah, and this is the Hawaii one, which is a pretty tame chart. I mean,
Yeah, right. And you compare it to like Las Vegas or Atlanta or Detroit.
yeah, I think that was last month's one, right? I had the slide with what Florida, Las Vegas, and Arizona, those plummeted, right, in the
Super
2000.
big hits. Yeah, super big hits. So to your point too, yeah, Lane, exactly. It's a lot more tame than how other parts of the country took it. Yeah. And so again, talking about putting things in perspective, and if as an owner occupant, a lot of times you can't really time the market as much. But one thing that is good is I pulled this off of the mortgagenewsdaily.com, and seems like the 30-year fixed rate mortgage is at its 52-week low at 4%, 4.03. So I mean we're at lows again in terms of your 30-year mortgages. So good. And again, that's another sign. In my mind, it's like a good time for buyers too, right? Because especially owner occupants, you're not timing it as much as investor can, and you also can. Investors have different ways. You can choose different regions that you want to invest in, or different types of investments too. So good time. This is the point of this slide. Okay. I've been getting a lot of calls from people, what season it's tax season. So, my wife being a tax CPA, she's ramping up for 415, and now is the time to gather. For some people, it's their time to gather their documents and their support, put together their tax binders to provide to their CPAs, or bust out buy their TurboTax from Costco, or some people are even trying to find CPAs right now, believe it or not. And it's challenging, but trying to help people out how they can. But I guess my point is, this is also a good time for investors like us, Lane, is take a look at our real estate portfolio. All of our rent rolls and our 2018 statements are coming in, so we can calculate our return on our equity. Get CMAs done. Find out what the market rate is, and so you can find out how much equity you have in your investments, and that way you can properly calculate what kind of return you're getting on this equity, and you can determine, can I use, maybe there's other alternatives to use my equity and put it in better types of investments. It's kind of similar to how on an annual basis your financial advisor calls you and says, okay, let's talk about your stock portfolio. Is it time to rebalance? Try to look at what kind of how it changed over the year and how things get unbalanced in terms of market prices for different stock or bond portions of your portfolio. So I guess my point is, now is also a good time, besides doing your taxes, to take a look at your real estate portfolio and see if you want to start paring things down. Considering all things considered, especially we always talk about the corrections. Now might be a time to see if you want to make changes. Yeah.
Or maybe if you like the home you're going to live in, maybe now's the time to go lock up another 30-year debt and pull some money out.
Or get a or get a HELOC if you don't have one now, right? Something like that.
Which is
tap into that equity.
Which is makes people gasp in Hawaii, right?
But you and I have our own opinions on that, right, Lane?
Yeah. I mean, my your parents, if they're still working, now's the time to go and get that 30-year debt before they
Yeah.
lose their W-2 income and they can't qualify for anymore.
Yep, exactly.
Security is not an equity in your home.
Yeah.
That so if you guys are interested in more real estate investing, check out my podcast, Simple Passive Cash Flow, and simplepassivecashflow.com. Dean is starting to come out to the real estate club meetups here. You can check that out at reialoha.com. And if you want a free e-version of my book, go and text ebook to 587-317-6099. Just some random news here. I don't know if you caught this one, but Oregon okayed the first statewide U.S. mandatory rent control law. So you got rent control now in Oregon. And I don't want to get political here, but typically the people that kind of know what's happening money wise, you'll see these rent controls typically hurting the people that it made to protect. But I think this one is actually a pretty good idea. People will read a headline and have a thought, but if you dug into this, if you read on their left side, they cannot increase the rent increases more than 7% in 1 year. I think it's pretty fair.
That's very fair. I mean, it sounds like it makes me wonder something must have been happening for them to implement something.
Yeah, they were like pushing rents up like 10-20% on people. So if rents for like $1,000, it would go up like 120 next year.
Okay, so this is different.
Right. Yeah, that's not right. So
because I've heard other stories on the other side, from the landlord side, and say like in California where there is rent control, and the landlord hasn't been able to raise rents for like 5 years or stuff. So this is sounds like more like protection, for the tenant.
Right. Yeah. And it's just a good lesson. Like, you always got to read into this stuff a little bit, because I had it on my Facebook group, and I put it up there, and obviously the comments are always like, oh, rent control sucks, right? Like, well, you guys even read this article? Like, 7% is what it said.
Yeah, that sounds fair.
So I'm gonna get into a little bit more doom and gloom here. Something I've been kind of learning about recently is this. If you go online, you can search this 10-year Treasury yield, and this U.S. 3-month Treasury yield just inverted a few days ago, actually. And academics will call this an indicator of a recession. And also take notice that the Fed raised rates back in September, and December recently they announced that it envisions no rate hikes in 2019. So we've kind of talked about this in previous webinars, but the Fed raising rates is their ability to build up some dry powder in case there's some trouble ahead. So if the economy slows down, they can decrease the rates and kind of infuse cash into the system. Got this kind of showed in a different way. Got the 3-month in green there. So March 22nd was like the day that this pivotal moment happened. This is a phenomenon called yield curve inversion, and kind of wrote it down here. The blurb, my blurb on it. So the regular folks like us never really feel this, but this affects the bank's ability to pay by paying retail to CD savings of 1% using short-term interest rates like the 3-month or the 2-year yield. The regular people like us walking into the bank, they'll give us that 4 to 5% commercial real estate loan that we've been getting on these syndications, or you guys get that 3.5-4% loan on your primary residence backed by Fannie Mae, Freddie Mac. There's that difference there. The arbitrage is how the bank makes money.
Right. Yep.
So the short-term yield is higher than the 10-year Treasury yield, which is a little ass backwards. then the banks can't really make money, right? So if
Right,
the banks
right.
stop making money, they'll stop lending, and when the
Yeah.
banks stop lending, everybody goes, no, I don't know. I mean,
Yeah. Well, the spread's gonna be so low that they're gonna, like how in the past what they had to do is they started bumping up all these ticky tack fees here and there, and people start complaining. What is this fee for? Because now that, like you said, they can't make off the spread, so they got to make it off of something else. So then it might be fees or
oh, I
yeah,
didn't know that. When
yeah.
was that? When did that happen? Is it like the checking account fees and stuff like that?
Yeah, so that like yeah, exactly. And after subprime and like you said, the Fed rate dropped to bottom. So like you said, that spread, that arbitrage becomes so low that banks have a hard time. They're not making the money off that spread, so they have to find alternative ways. So then you see these fees popping up that weren't there before.
Yeah.
Yeah. So
So
that's
from the economy's perspective, companies start getting a little gun shy themselves, and that kind of starts the falling forward mechanism where everybody freaks each other out.
yeah.
And the equity markets is all based on emotion. So that's sort of the beginning of a recession.
Hmm.
But the question is, is it going to be, the soft landing type, or is it going to be the hard landing type, like how we had last time?
Yeah.
A lot of things I read, I read this, like, it's a paid subscription, ITR Economics, super smart guys, but they're predicting a more soft landing, and they've got several indicators that they look at. And yeah, I don't know, what are your thoughts? You think we're going to see another 2008 or .com thing again?
No, I mean, barring any other, hard external catastrophe, like you said, I see it more of the soft landing because of I'm thinking how U.S. fiscal policy, they're gonna try to manage that rate, and even monetary policy. I mean, I don't know. I mean, like you said, not to get political, but they just passed that. What are they doing? The money's billions of dollars for the wall, right?
Oh, really?
Yeah. So then
I thought that was a
that's
joke.
okay. That could be, but if that thing gets passed, and then we have all these dollars going back into the economy for the infrastructure, and that kind of helps in the short term. The economy from that standpoint, right?
Right, right. And Trump is generally pro-business, so he
Right.
usually is bullish for the economy.
Right. Right.
But yeah, he's kind
So
of known for the helicopter money. And when I mean helicopter money, they, usually when the government infuses cash into the system, they give it to the banks like Citibank, JP Morgan, that kind of stuff, which is messed up because it never really leaves them.
right.
So the idea is get a helicopter, take it over all these like corporations and put it right to the people.
Right.
The best way is shovel-ready projects such as a
Right.
wall, I guess.
Yeah. No. Yeah. Exactly. You pour it back into the infrastructure, and that's how it hits the economy directly. Versus, like I think when they after subprime crisis, like you said, they tried to pour it back into the financial system, but the banks still didn't want to loan out. So then that was the problem, right? The funding which was supposed to be given out was still dry. So financing was impossible still. So it didn't help us. That was the
Right,
challenge. Yeah.
right. So I'll show some more graphs on this next month, but I don't think it's anything to really be worried about. I mean, if you're investing for cash flow or you're buying a primary residence, um, I think it's still the time to do it. But if you guys sitting on a lot of equity and you don't want to live there forever, I'd say give Dean a call and sell that sucker quick. Now's the
Yeah,
time to do it.
or figure out ways to tap into the equity. If not, right? I mean, it's all based on situation, but that's a good point. I mean,
Yeah, but yeah, don't take my word or Dean words for it. Come out to our meetings, arialoha.com. We had one at Pi the other month. The next one is probably going to be April 18th.
ooh, after tax season sounds good.
Yeah, yeah. So that'll be the Breakfast Club one where we go out on Saturday morning, and it's more of an out-of-state investor focus for that one.
Sounds fun.
But any other projects there, Dean, that you got working on, or any other parting words?
Other projects? No, just looking into syndications, as you know, Lane. So I'm excited to see what my first endeavor is into syndications. I don't want to go too much into detail at this point, but yeah, that's my way of getting into a new industry, and hopefully, if and when there's a correction, we'll be able to ride it out.
Yeah, I hope so too. All right. Well, yeah, you guys can check us out at raaloha.com or check out my website, simplepassivecashflow.com, or contact Dean if you want to buy or sell something, and we'll talk to you guys next time. Bye.
See ya.
Hey, just some legal stuff here. Although these two brothers are pretty knowledgeable and have over 2,100 rental units and own over $160 million worth of real estate, the preceding are only ideas and not to be taken as legal, tax, or financial advice, okay? You should always seek the professional advice of other professionals on your team and think for yourself and do your own due diligence, okay? Aloha.
We're just two local guys with so much to say. So listen to the Real Estate Brothers today.